On paper, it looked like one of the easiest decisions in corporate America. Take a stock that has become too expensive for many investors. Split it, lower the price, increase accessibility, generate headlines. Most of America's iconic companies have done exactly that. For decades, stock splits have been celebrated as milestones, signals that a business has grown strong enough to make ownership more accessible to a wider audience. Yet one of the most successful companies in American history chose a different path. Year after year, as the value of its shares climbed into territory few individuals could afford, Berkshire Hathaway left its original Class A stock untouched. The price kept rising. Questions kept coming. Why not split the shares? Why make ownership so difficult? To many observers, the decision seemed stubborn, even outdated. But Warren Buffett wasn't trying to solve the problem everyone else was looking at. He was trying to solve a different one. Because in his view, the price of a share didn't just influence who could buy it. It influenced how people would think once they owned it. That belief shaped one of the most unusual public companies in America. It influenced the relationship between Berkshire and its shareholders. It affected how capital was allocated. It even changed the kind of conversations that took place at the company's annual meetings. This isn't a story about stock splits. It's a story about a philosophy that quietly challenged one of Wall Street's most accepted assumptions, that making something easier to buy always makes it more valuable. Sometimes, the opposite is true. Imagine you're leading one of the world's most successful companies. Your business has compounded value for decades. Investors admire your track record. Demand for your shares continues to grow. And with every passing year, the price climbs higher. Around you, other companies make a familiar announcement. A stock split. The market responds with excitement. Financial headlines celebrate it. Commentators describe it as a sign of confidence. For many executives, the decision feels almost automatic. But Berkshire Hathaway never treated it that way. To understand why, we have to look beyond the mechanics of the stock market. A stock split does not change the underlying value of a business. If a company worth $100 billion splits each share into two, the company is still worth $100 billion. The pie hasn't grown larger. It's simply been divided into more slices. Buffett understood that as well as anyone. So his reluctance was never based on confusion about finance. It was based on something more subtle. He believed ownership carries responsibility. When people buy shares in a company, they are not merely purchasing a symbol on a screen. They are becoming part owners of a business. That idea may sound obvious. Yet in markets driven by constant price movements, it is often forgotten. Buffett spent much of his career encouraging Berkshire shareholders to think like owners rather than traders, to judge decisions over years instead of days, to evaluate businesses instead of market sentiment. From his perspective, the structure surrounding a company should reinforce that mindset, not undermine it. As Berkshire's share price continued to rise, critics argued that a split would make ownership more accessible. Buffett saw another possibility. A lower share price might also attract investors whose primary interest was short-term trading rather than long-term partnership. That distinction mattered to him, because the people who own a company help shape its future, not by managing daily operations, but by influencing expectations. Patient owners give leaders room to make long-term decisions. Impatient owners often demand immediate results. For Buffett, protecting Berkshire's culture meant thinking carefully about both. The question was never simply, should the stock be cheaper? The real question was, what kind of ownership are we trying to build? That question would lead Berkshire Hathaway down a path unlike almost any other major public company. And the answer would reveal why one of Wall Street's simplest decisions became one of Warren Buffett's most deliberate refusals. The answer did not begin with a desire to make Berkshire exclusive. It began with a problem that appeared simple on the surface. By the mid-1990s, Berkshire Hathaway had become something almost impossible to ignore. A company that had once been a struggling textile manufacturer had transformed into one of America's most admired investment organizations. The market had watched Warren Buffett turn a failing business into a collection of extraordinary companies. Insurance, manufacturing, energy, consumer brands, rail transportation, a portfolio built not around quick wins, but around patience. And as Berkshire grew, something unusual happened. The price of a single Class A share continued climbing. For many investors, owning even one share became increasingly difficult. A question began appearing again and again. Wouldn't it make sense to split the stock? It was the obvious move. The move almost every company would make. A lower share price would allow more people to participate. It would make Berkshire appear more accessible. It would create excitement. But Buffett was not looking at the question from the perspective of a market strategist. He was looking at it as an owner. And owners think differently, because to Buffett, a shareholder was not simply someone holding a financial instrument. A shareholder was a partner. That word mattered. Partner, not customer, not trader, not someone checking a stock ticker every morning searching for the next movement. Partner, someone who understood that a great business is built over decades, not measured by tomorrow's market reaction. But there was another challenge developing. A challenge that had nothing to do with Berkshire's own performance. Came from outside the company. As Berkshire's reputation grew, demand for access to its success increased. Many smaller investors wanted exposure to Buffett's record. They wanted a piece of the company. But because the Class A shares had become expensive, opportunities appeared for others to create alternatives. Financial products were being developed that attempted to copy Berkshire's performance. The problem, from Buffett's perspective, was not that people wanted to invest. That was the purpose of a public company. The problem was how they were being offered access. Buffett believed some of these products were charging unnecessary fees and using Berkshire's reputation to attract investors who might not fully understand what they were buying. The situation created a difficult choice. He could simply split the Class A shares. That would immediately lower the price. It would solve the accessibility problem. But Buffett believed it could also change something more important. The character of Berkshire's shareholder base. And for him, that was not a small detail. It was the foundation, because a company does not only exist inside its factories, offices, and balance sheets. It also exists inside the relationship between leadership and ownership. The wrong ownership structure can create the wrong incentives. A company surrounded by short-term thinking can begin making short-term decisions. A company surrounded by patient owners has more freedom to think years ahead. Buffett had spent decades building Berkshire around patience. He did not want to accidentally weaken the very culture that helped create the company's success. So instead of doing what everyone expected, he chose another path. In 1996, Berkshire Hathaway introduced something new: Class B shares. At first glance, it looked like Buffett was changing direction. A company that had refused to split its famous Class A shares was now creating a lower-priced alternative. Some observers wondered, had Buffett finally accepted that the stock had become too expensive? Had he changed his philosophy? The answer was more interesting. He had not abandoned the principle. He had found a way to protect it. The creation of Class B shares was designed to provide investors with a more accessible way to own Berkshire without changing the identity of the original Class A shares. It was a compromise, but it was a very Buffett-style compromise. Solve the problem, protect the principle, make access possible, without sacrificing the culture. That decision revealed something important about how Buffett viewed business. Great leaders are not always trying to make everything bigger. Sometimes they are trying to protect what made growth possible in the first place. And that is where the story becomes bigger than a stock split. Because the real question was never, why didn't Warren Buffett make Berkshire's shares cheaper? The real question was, why was Buffett so determined to protect the type of people who owned Berkshire? The answer would define one of the most unusual relationships between a company and its investors in modern business history. And decades later, it would become one of the clearest examples of a billionaire understanding something most companies overlook. The people who own a business can become part of the business itself. The most revealing decisions in business are not always the ones that create attention. Sometimes they are the ones that quietly prevent something from happening. For Warren Buffett, refusing to split Berkshire Hathaway's Class A shares was never about making a statement. It was about protecting a system built around one unusual idea. A company should care deeply about the people who own it. That idea sounds simple, but in modern markets it is surprisingly rare. Most public companies spend enormous effort attracting investors. They monitor analyst expectations. They study market reactions. They focus on quarterly performance, because every day their stock price is being judged. But Buffett saw a different relationship. He believed the market should not control the company. The company should serve long-term owners. That philosophy became the foundation of Berkshire Hathaway. And one of the clearest expressions of that philosophy was the way Buffett communicated with shareholders. Every year, investors around the world waited for a document that was unusual in corporate America: the Berkshire Hathaway annual letter. It was not filled with complicated financial language designed to impress Wall Street. It was written almost like a conversation. Buffett explained mistakes. He discussed decisions. He admitted failures. He talked about business principles, because he wanted shareholders to understand the way he thought, not just the numbers. This was important because Buffett was not trying to attract every possible investor. He was trying to attract a specific type of investor, someone who viewed Berkshire as ownership in a collection of businesses, someone willing to ignore short-term market noise, someone who understood that real wealth creation often looks boring while it is happening. And that mindset connected directly to the stock price question. A lower share price could make Berkshire easier to buy. But Buffett believed accessibility and alignment were not always the same thing. More buyers did not automatically mean better owners. And better owners mattered, because ownership creates expectations. Imagine two investors buying the same company. One investor believes, "I own part of a great business. I want management to think 5 or 10 years ahead." The other thinks, "I bought this stock. I need results immediately." Both investors legally own the same company, but psychologically, they are completely different. And over time, those differences can influence the decisions a company makes. Buffett understood this better than most. He had watched businesses destroy long-term value by chasing short-term approval. Companies cutting important investments to satisfy quarterly targets. Executives making decisions designed for headlines rather than durability. Buffett wanted Berkshire protected from that pressure. The share structure became one of the tools that helped preserve that environment. But the deeper principle was not about price. It was about identity. What kind of company was Berkshire Hathaway? What kind of relationship did it want with its owners? And what kind of behavior did it want to encourage? Those questions mattered because Berkshire was never built like a typical corporation. It became something closer to a permanent capital machine, a collection of businesses managed from the financial engine, operating companies creating real economic value, managers given independence to run their businesses, and shareholders who understood the mission. The stock was only one piece of the structure. The culture was the real asset. And Buffett knew something many leaders learn too late. Culture is easier to protect before it is damaged. Once the wrong incentives enter a system, repairing it can be almost impossible. That is why the Class A shares remained untouched. Not because Buffett wanted Berkshire to appear expensive. Not because he wanted ordinary investors excluded. But because he believed the ownership structure was part of the company's DNA. The decision was not designed to impress Wall Street. It was designed to preserve Berkshire's way of thinking. And that way of thinking would soon face its biggest test. Because a company can protect its culture in theory. The real question is whether that culture survives when billions of dollars are on the line. And in 2010, Berkshire Hathaway faced exactly that moment. A historic acquisition. The largest deal in the company's history, and a situation where Buffett had to prove whether his philosophy about ownership could adapt without breaking. For Warren Buffett, principles were never meant to be slogans. They were meant to survive pressure. And in 2010, Berkshire Hathaway faced a moment when the company's philosophy would be tested on one of the biggest stages in corporate America. The target was not a small investment. It was an American institution, the railroad company Burlington Northern Santa Fe, a business deeply connected to the history of the United States. The rail network that carried goods across thousands of miles. The infrastructure behind America's economy. Buffett believed the railroad represented something rare. A high-quality business with long-term importance. A company that could continue creating value for generations. But completing the acquisition required something unusual. Berkshire needed a practical way to use its Class B shares in the transaction. This created a fascinating situation. For years, Buffett had resisted splitting Berkshire's original Class A shares. Yet now, the company would split its Class B shares. In 2010, Berkshire completed a 54-1 split of the Class B shares. To some observers, it looked like a contradiction. The billionaire who refused to split Berkshire's famous stock was suddenly approving a stock split. But the details revealed the real philosophy. Buffett was never against the mathematics of a stock split. He understood that a split does not create or destroy value. A company worth a certain amount remains worth that amount whether ownership is divided into fewer expensive shares or more affordable shares. The issue was never the number. The issue was the behavior surrounding the number. The Class A shares represented Berkshire's original ownership culture, a shareholder base built around patience, long-term thinking, business ownership. The Class B shares served a different purpose. They allowed Berkshire to expand accessibility while still maintaining the philosophy behind the company. That distinction is what made Buffett's decision unusual. He was not protecting a high stock price. He was protecting a high standard of ownership. And there is a major difference. Many companies focus on increasing the number of people who can buy their stock. Buffett focused on attracting the right people to own it. That idea runs against much of modern business thinking. Growth is usually measured by expansion. More customers, more users, more attention, more volume. But Buffett understood that not all growth is equal. The wrong kind of growth can create problems that are difficult to reverse. A company can gain millions of new participants and still lose something valuable. Trust, alignment. Shared expectations. Berkshire Hathaway's unusual structure became a filter. It was a message, a signal to the market about what kind of relationship the company wanted with its owners. And over time, that message became part of Berkshire's identity. Investors did not come to Berkshire because it promised excitement. They came because it represented discipline. They came because Buffett communicated honestly. They came because the company operated with a level of patience rarely seen in public markets. The annual meetings became famous not because they were flashy. They became famous because they felt different. Thousands of shareholders gathered in Omaha not simply to hear about stock performance. They came to learn, to ask questions, to understand how one of the world's greatest capital allocators thought. The culture surrounding Berkshire became almost as valuable as the businesses inside it. And that may have been Buffett's greatest insight. A company is not only built by the assets it owns. It is also built by the expectations it creates, the investors it attracts, the behaviors it rewards, the decisions it refuses to make. That is why the stock split question was never really about a stock split. It was about whether a company should allow market pressure to reshape its identity. Buffett's answer was clear. A great company should not simply ask, "How do we attract more owners?" Should ask, "What kind of owners will help us remain great?" That question explains why Berkshire Hathaway became one of the most respected companies in modern business history. Because while other companies were focused on making ownership easier, Buffett was focused on making ownership meaningful. And that decision reveals one of the most overlooked lessons from his career. The strongest leaders do not only build businesses. They build systems that protect those businesses long after the original decisions are made. The most powerful decisions in business are often invisible. They do not create a dramatic announcement. They do not produce immediate applause. Sometimes, the greatest victories are simply the problems a company never has to face. For Berkshire Hathaway, the decisions surrounding its stock structure created exactly that kind of advantage. It protected something that cannot easily be measured on a balance sheet: trust. Because over decades, Berkshire built something unusual: a shareholder base that understood the company's personality. That may sound strange. After all, investors are supposed to care about returns, numbers, performance, growth. But Buffett understood that the relationship between a company and its owners goes deeper than financial statements. A company's shareholders influence the environment around leadership. They influence the questions executives receive. They influence the pressure management feels. They influence whether leaders can make unpopular decisions that may only pay off years later. And Berkshire Hathaway needed that patience. Because many of Buffett's greatest decisions looked questionable before they looked brilliant. Buying struggling companies, holding cash during uncertain markets, refusing to follow Wall Street trends, ignoring the pressure to chase whatever industry was popular at the time. Those decisions required something rare: time. And time requires the right ownership culture. A company constantly fighting impatient investors may never have the freedom to think long-term. Berkshire had created an environment where long-term thinking was not just encouraged. It was expected. That became one of its hidden competitive advantages. Not a factory, not a patent, not a piece of technology, a philosophy. And philosophy, when built into a company structure, can become incredibly difficult for competitors to copy. Many companies can copy strategies. They can copy products. They can copy marketing campaigns. But copying culture is much harder. Because culture is built through thousands of decisions over many years. Berkshire's unusual approach to ownership became part of that culture. The company was effectively saying, "We are not interested in attracting everyone. We are interested in attracting people who understand what we are building." That principle appears throughout Buffett's career. He has repeatedly emphasized that Berkshire's goal was not to maximize the number of shareholders. It was to create a relationship with shareholders who shared the company's way of thinking. And this explains one of the great misunderstandings about the stock price. Many people looked at Berkshire's expensive Class A shares and saw a barrier. Buffett saw a filter designed to encourage a different kind of commitment. Not perfect investors, not guaranteed investors, but investors more likely to think like owners. That distinction became especially important during periods of uncertainty. Markets rise, markets fall. Fear spreads quickly. Headlines change every day. But companies with patient ownership have something valuable: the ability to ignore noise. Berkshire could focus on decisions that made sense over decades because the people around the company understood that philosophy. The result was not simply a successful investment record. It was an ecosystem. A company where leadership, communication, and ownership were aligned around the same idea: long-term value. And perhaps the most fascinating part of Buffett's decision is that he solved a problem most executives never consider. Companies spend enormous energy asking, "How do we get more people interested in our business?" Buffett asked a different question: "Who do we want interested in our business?" That is a much harder question, but it may be a more important one. Because growth without alignment can become dangerous. More attention does not always create more value. More owners do not always create better ownership. More accessibility does not always create stronger commitment. Buffett understood that sometimes the greatest protection for an empire is knowing what not to change. And Berkshire Hathaway became a living example of that principle. A company that grew by refusing to follow one of Wall Street's most common expectations. A company that proved a simple idea: the structure around a business can influence the future of that business. The stock split decision was only one choice, but behind that choice was a much larger philosophy. A philosophy about trust, a philosophy about patience, a philosophy about building something designed to last. And that may be Warren Buffett's real lesson. The greatest companies are not only built by finding great opportunities. They are built by protecting the conditions that allow greatness to continue. In the end, Warren Buffett's decision was never really about a stock certificate. It was about something much bigger. It was about understanding that every great organization has something valuable that cannot be easily measured. Its identity. A company's identity is built slowly, through thousands of choices, through the standards it refuses to abandon, through the people it chooses to serve, and through the things it decides not to chase. That is the part many businesses misunderstand. They believe growth is always the answer. More customers, more attention, more transactions, more expansion. But Buffett's career reveals a different truth. Not all growth strengthens a company. Some growth weakens it. Because when a company expands without protecting its foundation, it can lose the very thing that made people value it in the first place. Berkshire Hathaway's stock structure was one example of that principle. Buffett understood that ownership was not just a financial transaction. It was a relationship, and relationships depend on alignment. The company needed owners who understood the mission, owners who valued patience, owners who could see beyond the movement of a single day. That idea applies far beyond Wall Street. A luxury brand understands this. A great restaurant understands this. A respected institution understands this. They do not simply ask, "How can we attract everyone?" They ask, "Who are we trying to serve?" Because the answer determines everything. The experience, the culture, the decisions, the future. This is one of the reasons Buffett became one of the most respected business leaders in the world. Not because he predicted every market move. Not because every decision was perfect. But because he understood a principle that many leaders overlook. The people surrounding your business influence the future of your business. Employees, customers, partners, investors, communities, the ecosystem matters, and protecting that ecosystem sometimes requires unpopular decisions. The easy decision is often the one that creates immediate excitement. The difficult decision is the one that protects long-term value. That is what makes Berkshire Hathaway's story so fascinating. Buffett was willing to look strange in the short term to remain strong in the long term. While others chased popularity, he focused on durability. While others optimized for attention, he optimized for trust. While others asked how to increase demand, he asked how to maintain quality. And that mindset created something rare. A company built not only around financial performance, but around consistency. For entrepreneurs, the lesson is powerful. Your greatest asset may not be the product you sell. It may be the principles that guide how you build. For investors, the lesson is equally important. A great company is not only defined by what it earns. It is defined by the behavior, discipline, and decisions that produce those earnings. And for leaders, perhaps the biggest lesson is this. Sometimes protecting an empire requires refusing the very thing everyone else believes you should do. Because success creates a new challenge. The challenge is no longer building something valuable. The challenge is protecting what made it valuable. That was Warren Buffett's unusual insight. He understood that companies do not collapse only because they fail to grow. Sometimes they fail because they grow in the wrong direction. Berkshire Hathaway's Class A shares remain a symbol of that philosophy. Not because an expensive stock price is automatically better. Not because accessibility is wrong. But because every decision sends a message. Every structure creates behavior. Every choice shapes culture. And the greatest leaders understand that. They are not just building companies. They are designing systems that can survive them. That may be the most important reason Warren Buffett's decision still matters today. Because decades after the choice was made, the question remains. What are you protecting while everyone else is trying to expand? For more than half a century, Warren Buffett built one of the greatest business stories in American history. But the most interesting part of that story was not only what he bought. It was what he refused to change. A struggling textile company became a global investment empire. A small group of shareholders became a worldwide community of long-term owners. A simple idea about ownership became a philosophy that shaped one of America's most respected companies. And at the center of it all was a decision that looked unusual. A decision that many people questioned. Why would Warren Buffett refuse to split Berkshire Hathaway's Class A shares? Why would he leave one of America's most valuable stocks at a price few individual investors could easily purchase? The answer was not arrogance. It was not about creating a symbol of wealth. It was about something much deeper. Buffett understood that every business decision creates consequences beyond the numbers. A price creates expectations. A structure creates behavior. A culture creates the future. And sometimes the most important thing a leader can protect is not growth. It is alignment, because building an empire is only half the challenge. The harder challenge is making sure the empire remains what it was built to become. That is the hidden lesson behind Berkshire Hathaway. The greatest companies are not created only through opportunity. They are created through discipline, through knowing when to move, and knowing when not to. In a world where businesses constantly chase attention, Buffett built around trust. In a world where companies often focus on short-term reactions, he focused on long-term relationships. In a world where everyone asked, "How can we make this bigger?" he asked, "How can we make this last?" And perhaps that is why this decision remains fascinating decades later. Because it reveals something about success that applies far beyond investing. Whether you are building a company, a brand, career, or a legacy, you will eventually face the same question. What are you willing to protect? What values are so important that you refuse to trade them for temporary growth? Because every empire reaches a moment when expansion becomes easier than preservation. And that moment reveals the true character of the person leading it. Warren Buffett's decision was not remembered because he avoided a stock split. It was remembered because it represented a way of thinking. A belief that great businesses are built by carefully choosing what they allow into their system. The right customers, the right partners, the right employees, the right owners, the right principles. That is the difference between creating something valuable and creating something that survives. The story of Berkshire Hathaway was never really about a stock price. It was about understanding human behavior, because markets are not only made of numbers, they are made of people, and the leaders who understand people often build the organizations that stand the test of time. This was the quiet decision that protected Warren Buffett's empire. Not the loudest, not the most dramatic, but perhaps one of the most revealing. Because sometimes the decisions that define greatness are not the ones where a billionaire says yes. Sometimes, they are the moments when a billionaire says no. Behind every great empire is a decision most people never saw coming. A mistake, a bet, partnership, a refusal, a moment where everything could have gone differently. And those moments are where history changes.